Hi, Martin Turner here. This week we have our first of two lectures on predicting the future. We move from understanding the past to shifting our focus to the future. We first review the key accounting drivers as we look at the video Key Accounting Drivers. We then shift our focus to the future and look at sales growth and how not all sales growth is good. We consider the economic and business drivers of our firm's accounting drivers by looking at Ryman Healthcare. And we consider the issue of how we can connect our firm's accounting drivers with their economic and business drivers. And first, let's look at the key accounting drivers. Welcome everyone. Today we're going to start our two-week lectures on predicting the future. We've been looking at the past and understanding the past, but no one ever gets rich from understanding the past. In business, we're always future focused, and we're taking the perspective of equity investors in a firm, and from their perspective, they're interested in the trip to come. My children have been shareholders in Ryman Healthcare for the last 20 years, and it's been a great trip so far. They've done 50 times their money. But that's the past. If you buy shares in Ryman's today, you don't get to go on that trip. That's finished. But if you buy Ryman shares, for example, or shares in any company today, you're going to go on the trip in the future. So how do you predict the future? Another way of saying it is 20 years ago when Ryman Healthcare floated, how do you assess whether that would be a good investment or not? What is its outlook for the future? Easy to tell now what happened the last 20 years in the past, or at least there's some skills in analysing it properly, but it's still relatively straightforward. But predicting the future, quite a different kettle of fish. And we're going to see there's a lot of judgments and technical skills involved, and this will be a much tougher half of the unit now. Once people have laid a very good foundation, and we'll be going forward. So that's what we'll be looking at today and next week. First of all, we'll review a few key concepts from the past, and particularly looking at accounting drivers, return on net operating assets and net operating assets. We've been looking at the past, and we're going to then be forecasting the economic and, we'll look at the accounting drivers, then the economic and business drivers of those accounting drivers, and it's those economic and business drivers that we'll be forecasting. Life isn't as simple as just forecasting the accounting numbers. We have to go beyond. We have to connect the accounting numbers to the business itself. And we'll also be looking at, next week, we'll be looking at beyond our forecast horizon. We'll be all forecasting 5 years for our firm. You can, in practice, you would choose a period, probably a different one for different companies, but we'll use 5 years. And then also we need to forecast beyond that 5-year forecast horizon, and we'll be looking at issues around that. Key accounting drivers. There's a great video on this, Key Accounting Drivers, which is in the videos for weeks 4 to 6, and the key accounting drivers for economic profit and cash flow. It's economic and profit and cash flow, those frameworks that we'll be focused on in seeking to identify the key accounting drivers of our firm and then what's driving them. And so let's have a look at the video Key Accounting Drivers, which is from Accounting for the Past. If you are wondering what the key accounting drivers of your firm are, this video will look at the key accounting drivers of our firms through the lenses of the discounted cash flow and economic profit frameworks. In the videos analysing return on equity leverage, profitability and efficiency, we saw how we could analyse or break down return on equity into several accounting drivers, ratios that are causing return on equity of our firms to be at the levels they are. Now we can focus on the enterprise, which is on our firm's operating activities, if we think the financial activities of our firm are not adding value.
See the video Benefits of Focusing on the Enterprise. This means we can focus on return on net operating assets and on its drivers of profit margin and asset turnover, and in turn on the drivers of profit margin, operating income and sales, and asset turnover, sales and net operating assets. We know free cash flow equals operating income minus change in net operating assets. And we know that economic profit is driven by the book value of equity, as well as by the present value of abnormal earnings. Key accounting drivers of our firms that we can focus on are return on net operating assets, profit margin, asset turnover, sales and sales growth, and net operating assets. These accounting drivers are not themselves driving the value of our firm, but like all accounting numbers, are simply passengers on the journey of our firm and its equity investors and other stakeholders. Why focus on these key accounting drivers? Because by focusing on the key part of a firm's financial statements, these accounting drivers, we can focus our attention on connecting these accounting drivers to the economic and business drivers that are driving these accounting drivers. Connecting the accounting drivers with a firm's economic and business realities is at the heart of financial statement analysis. See the video Connecting to Reality. This is because forecasting a firm's economic and business realities and then connecting these forecasts to a firm's future accounting drivers and financial statements is what financial statement analysis is all about. And it is the quality of our judgments in forecasting a firm's economic and business realities and connecting them to a firm's future accounting drivers that is the basis for a quality valuation of our firms. And it is carefully connecting the past accounting drivers to the past economic and business drivers that is the basis for us to then make our forecasts. Analysing a firm is not simply calculating a few ratios. It is not that simple. And it all requires technical skills and judgments working together. For further information on accounting drivers, go back to Chapter 4, Sections 4.3 and 4.4 in the study guide, and also review Understanding the Past weekly questions. Also answer, write and rate questions on Understanding the Past in Peerwise.
Okay, that's a revision of those key accounting drivers, which is what we've been looking at in recent weeks, in weeks 4 to 6. So these are the key accounting drivers for our firms. And we're using the economic profit cash flow frameworks, and that way of thinking about value-adding businesses leads us to these key accounting drivers. Return on net operating assets, profit margin, asset turnover, sales and sales growth, and net operating assets. So we're focusing now on the key accounting drivers. These are certain aspects of the financial statements. When people first look at financial statements, say back in first year, they look at the financial statements of their firm for the first time. They may not have looked at financial statements of firms before, and they don't really know what to focus on. So they sort of look at the pictures and they see a big cheque being handed over on some charitable thing, or they look at the salaries of the senior staff and all this sort of thing. And they sort of, often people comment on, well, what should I be looking at? There's just so much information. And there's an enormous amount of information on all of our firms, not just in the financial statements, but also in the public arena generally. So what do we focus on? So that's what we've been looking at in terms of these key accounting drivers. These are the key elements of our firm's financial statements that will be driving economic profit and cash flow. But just as we said in the video, these accounting numbers, we call them accounting drivers, but they're not driving value. They're just numbers. The numbers could be anything depending on what accounting policies or, the accounting standards we had. But what we're interested in is using the numbers to connect to what's driving them in our business, in the economic and business realities. So that's the focus of what we'll be looking at. Now, before we do that, we're going to have a look at sales growth and good and bad sales growth. There's 2 videos on that we're going to look at. Sales and sales growth are key elements of a business in terms of adding value. And we're forward-looking now. What are the sales and sales growth going to be in the future? And that'll be one of the key aspects of the business that we'll be looking at. Now, just to help us start to think about that, let's have a look at the video on sales growth. And this is in the videos for weeks 7 to 8. Let's have a look at that one.
Are you wondering why forecasting sales is often important for many businesses? In this video, we will look at why sales growth can be important for a firm to add value to its equity investors. A firm's economic profit can be shown as return on net operating assets in excess of its cost of capital, weighted average cost of capital, all times the amount of net operating assets the firm has invested in its business, earning that level of return on net operating assets. This is where we are focusing on the enterprise, on our firm's operating activities. If return on net operating assets is greater than a firm's weighted average cost of capital, then the greater the book value of net operating assets, the greater will be a firm's economic profit. We can identify the effect of sales on the change in net operating assets. Asset turnover equals sales divided by net operating assets, and 1 over asset turnover, the inverse of asset turnover, is net operating assets divided by sales. We can present net operating assets as equal to sales times net operating assets divided by sales. Substituting 1 over asset turnover for net operating assets divided by sales, we get net operating assets equals sales times 1 over asset turnover. And so, change in net operating assets equals change in sales times 1 over asset turnover. What this shows is that the change in the book value of a firm's net operating assets is driven by its change in sales and by changes in the amount of net operating assets needed to generate $1 of sales. That is 1 divided by asset turnover. Sales growth is usually a key driver of increasing the book value of net operating assets and increasing economic profit and cash flow and the value of a firm. This is because growing sales usually requires investment in net operating assets, such as additional inventory, property, plant and equipment, and accounts receivable. For further information on sales growth, go back to Chapter 5, Section 5.2 in the study guide. Also, review Predicting the Future weekly questions. Also answer, write and rate questions on predicting the future in Peerwise.
Okay, so the sales is a key driver of the sales growth going forward. Sales going forward is a key driver of value for most businesses. And so that'll be an important area that you'll be looking at, as well as all the other accounting drivers, what's driving those. But so you can look at these videos. There's a number of videos to support weeks 7 to 8. Forecasting cash flow and economic profit, sales growth, good and bad sales growth, which we're going to discuss now, forecasting net operating assets and the forecast horizon, for example. And you can have a look at these videos. You can turn them on and off when you're just trying to come to grips with some of these concepts. And you can adapt them and apply them to your firm as you're going through. And you can be working through aspects of your assignment. So sales growth is important. And sales. But the key is there's good and bad sales growth. Some sales growth will be great for adding value to equity investors, and others will destroy value. So it's quite important to be able to distinguish between good and bad sales growth. So there's a short video on that issue of good and bad sales growth, and then we'll just discuss that briefly. So let's have a look at this video now.
Have you wondered whether all sales growth is good? Is adding value to equity investors? In this video, we look at how we can tell the difference between good and bad sales growth. Did you know that not all sales growth is good? Indeed, there is good and bad sales growth. But how do we tell the difference? Sales growth is a key driver of increasing the book value of net operating assets and increasing economic profit and cash flow, and the value of a firm. We talk about this in the video Sales Growth. But we know our sales force and marketers could generate sales growth by discounting price, offering additional benefits to customers, and increasing our firm's product range to increase customer choice, and so increase inventories and the general complexity and costs of its business. This could all be great for customers, but I've seen several businesses destroy substantial value for equity investors by uncritically pursuing strategies such as these to grow sales. Clearly, some sales growth will add substantial value to equity investors, while other sales growth will not. Some sales growth will be good, value creating, and other sales growth will be bad, value destroying for equity investors. So how can we tell the difference between good and bad sales growth? Change or growth in net operating assets depends on the interaction between sales and asset turnover. Growth in sales that keeps asset turnover unchanged will lead to growth in net operating assets. But growth in sales that reduces asset turnover, for example by requiring higher levels of inventory per dollar of sales to support a more diverse product range, or by increasing accounts receivable per dollar of sales to support more generous terms of trade with customers, would also lead to growth in net operating assets. However, is this necessarily a good thing for equity investors? We know that economic profit equals return on net operating assets less weighted average cost of capital, all times net operating assets. We also know that profitability, profit margin, and efficiency, asset turnover, are key accounting drivers of return on net operating assets. Actions to grow sales that reduce asset turnover will increase net operating assets, but will also reduce return on net operating assets. Depending on which effect is greater, this type of sales growth may increase or reduce economic profit, and so either add or destroy value to equity investors. Equally, growth in sales that reduces profit margin, for example through reducing prices while keeping costs constant, will also increase net operating assets and reduce return on net operating assets. Again, depending on which effect is greater, this type of sales growth may either add or destroy value to equity investors. It is critical to be able to distinguish between sales growth that adds value and sales growth which destroys value to equity investors. The economic profit framework provides a conceptual way of thinking about this and can help us identify good and bad sales growth. For further information on good and bad sales growth, go back to Chapter 5, Section 5.2 in the study guide. Also, review the Predicting the Future weekly questions. Also, answer, write and rate questions on predicting the future in Peerwise.
Great. So again, these various videos are an integral part, just as the study guide is, of the content in our unit. And you can go to these videos and stop and start them as you seek to deal with some of these issues for your firm. But this is now your mission, should you wish to accept it. Well, you have accepted it because you're in the unit. Is you're going to need to be forecasting your future accounting drivers. What's your sales going to be? You know, what sales growth? What's your future sales going to be? What's your future return on net operating assets going to be? And your asset turnover. And So you'll be forecasting these accounting drivers over the next 5 years, and in fact to eternity. And so how are we going to do this? Well, what's happened here? That's what's going on. I see, yeah. So what we have to do is let's take return on net operating assets. We can't just predict the number out of the year. Like Ryman Healthcare might have a return on net operating assets of 15% today, but that doesn't mean it'll have 15% in the future. How do we forecast those numbers? Well, we need to connect back to what's actually driving that accounting driver, in this case return on net operating assets, in reality, the economic and business realities of the firm. What is causing Ryman Healthcare to have such a strong return on net operating assets in the past? And then we need to forecast those factors, those economic and business realities, those economic and business drivers, which are the real drivers of value, say for Ryman Healthcare. We need to forecast those into the future and then connect them back to the future return on net operating assets and other accounting drivers of our firm. And as we do that, we can then convert those accounting forecasts of accounting drivers into value for our firm using the economic profit and cash flow frameworks. So this is what we'll be doing. And turning those forecasts into future accounting drivers. So, here's our first question. What are the key accounting drivers of your firm? So, we'll go to you can answer them here. What are the key accounting drivers of your firm? But I'll type in, from your studies so far, this is looking at the past, what have been the key accounting drivers of your firm? Your firm might have been adding value or destroying value for equity investors, but what were the key accounting drivers?
Just having an issue with my internet.
Internet, yeah, something's been going funny here too. First, we've got one response. Oh, Maria, I might ask you to discuss them as they come through. We can both discuss them, but we've got one response. I think I can't really say it's so small, but I think they're referring to return on net operating assets. What are the key accounting drivers of your firm? And you might even include some numbers if you've got them in your mind, broadly, what your firm is. Your return on net operating assets greater than your weighted average cost of capital? We're generally using 8% for our weighted average cost of capital in our unit, unless people want to use a different number. Have some good reasons for it. What else have we got? We've just got the one response. What are the key... Are people having any trouble with the internet or...
It seems to be working now. I had to go through 5 blocks. So.
Yeah, there was some issue. The computer here hasn't been working completely, right?
We're just sort of having a bit of a discussion, so we haven't actually entered in. Well, Hannah's entering in things, but then as we're discussing it, we kind of change.
That's all right. We can wait a few minutes. That's fine. We can keep working. Justin might be working on his up in Cairns. I don't know if Sarah's working on hers by herself while sick, or Yvette, or Jemmy soon. Just you can look back at your whatever material you've got with you as well. What are the key accounting drivers of your firm? You can answer this in many different ways, even if you're just referring to some of the terms. for example, for Ryman Healthcare, key value driver has been its high return on net operating assets compared to its weighted average cost of capital. Been able to do that in a sustained way over its 35-year life. And 20 years of it has been a listed company. And it's been able to grow its net operating assets very strongly. So what else have we got?
Martin, I'm just going to, this is Maria again, sorry. Can I use Hannah's company and just ask you some questions from me?
Yeah, of course.
We understand her key accounting drivers of her firm. So she's got Aeroflot, which is, they've been aggressively increasing what I think is their net operating assets, so their fleet of aeroplanes. They haven't really had very profitable years, but when we analyse their sales growth, they have had an increase in the sales growth of between, say, 10 to 15% over the last couple of years. So we've got the key accounting drivers of her firm, the 5 that you listed on the slide, the NOAA, sales growth and so on. Translating that into her economic and business realities is her firm, so Aeroflot, is increasing their asset turnover, the ATO, the inverse ATO relationship, because they're increasing the fleet of planes, which is increasing their NOA, their net operating assets, which is then increasing their return on net operating assets. Is that sort of the logic that we're...
Almost. But what you're saying is that Aeroflot has had 10 to 15% sales growth last numbers of years. Is that right? Strong sales growth and strong growth in net operating assets. Is that right?
It's the growth in net operating assets is
So they've kind of jumped up and down over the last 4 years. They go up and then they go down. So there's nothing consistent. And I think this is where we're kind of, is it or is it not? We go back and forth discussing things.
And the growth in net operating assets are all negatives.
Their net operating assets have been declining, has it? Also, with airlines, they buy lumpy things like airplanes and so forth. So that can be quite lumpy. Ryman Healthcare can be a little bit like that because it completes retirement villages in sort of lumpy ways, so it can sort of be a bit like that. But you can see the importance. What happens now is you start to realise, how well do I understand what's been going on in the past? Some people have been connecting very well to that, others not quite so well. You might have got all your numbers into the spreadsheet, but some of the thinking through some of these issues. So this will help you to come back to it. But if I'm hearing that right, Aeroflot might have been upgrading its fleet a lot into newer planes. It might have been buying certain sorts of ones. And numbers of airlines are sort of buying, certain sorts of those, what do you call them, single aisle planes that can have long distances they can go, and they're very fuel efficient. And they might be investing in that, and they might be growing their sales in various ways. But what has their return on net operating assets been in the past?
I think that's been up and down as well. And so, again, this is just me thinking through things with Hannah. They've also had some crashes and some dodgy safety things. How does that impact in what we're talking about?
Crashes are not good for airlines. Aeroflot had a crash earlier this year, regardless of what caused it. Like Malaysian Airlines got 2 a few years ago. And, it may not have had anything to do with what they were doing. Like, one was shot down out of the sky by a Russian, missile. And so that was just random. It could have been the plane after it, which was a different airline. It's just plane after plane going through that area, and that destroyed their business. So, and I remember in private equity, was it private equity? No, it was in my mergers and acquisitions days. We were advising an airline. It's actually called Rex now, but back in the old days it was called Hazelton Airlines, a regional airline, and one of its key risks was having a plane accident. And if that happens, that's going to really knock around, you know, your reputation, sales, how people feel about you and stuff. And so, you know, it's an issue of risk in an airline. It's one of the reasons why I don't like airlines. They have the risk of accidents. And Aeroflot's been making a habit of it over a long period of time. When I was in investment banking years ago, one of the IT people went away on holidays, and then we heard that he died in a plane crash in Russia, one of these Aeroflot planes. And the risk of dying in Africa and Russia is 2 or 3 times the rate of the rest of the world. Just the risk factors, they just have a lot of crashes, so that's not going to help them. When you think of Aeroflot, you think of an airline that you don't want to fly in. So they're issues. But you can look at you know, it's got strong sales growth and strong net operating assets growth, but was it generating economic profit in the past?
Well, we don't think so from what the numbers that we've put in.
Well, it's not, I don't think so. You calculated the economic profit of the last few years, you know, the ratios. So you can look at that.
1, 2 positives and 2 negatives, yeah. I thought it was a bit up and down.
Yeah, so these are and it's coming to grips with what's been causing that. And you see how our model, we can break it down into those key accounting drivers and look at the high sales growth and high net operating assets growth. You've got return on net operating assets, which was bouncing around, and then you can look at why it was bouncing around with the profit margins and was the asset turnover fairly constant or not? It usually is, unless they're doing something substantially in reorganising their business, or there's some economic downturn, and then what's been happening to their profit margins and why.
Okay,
And
so we're on the right track with that sort of discussion.
Yeah, okay. So they're the issues, yeah. And you can see, you want to talk with other people and compare their businesses. We've got a few airlines, got a few other sorts of businesses. And then you can see, when you're looking at sales growth, was it good or bad sales growth and why? And you can see the model that we've got in those 2 videos. And when you're using the economic profit model, it gives you a framework to start to think about what makes good sales growth and what doesn't. If you're running a business, you need to have a really good grip on what sales growth is good and what isn't. And it's amazing how people can grow sales and destroy value. And in private equity, we'd often simplify businesses we bought, because we would buy businesses we thought we could grow strongly. And sometimes we'd buy businesses where we could just strip out some of the non-value-adding activities or sales in there and focus in on where they're really adding value. And that's what management should be doing. So, and what's going to happen, you see, once you start looking at this, you're going to start realising, some people will start realising they don't really understand their firm's business very well. And so you have to go back and figure out what was driving your accounting drivers in the past. I'm going to take you through Ryman Healthcare and discuss that process. But that's what you'll be going through. In accounting, just as in business, but in accounting, people are not interested in the accounting numbers. They don't care. The numbers could be anything, depending on the accounting rules. What people care about is the business. The business. And so what are the accounting numbers telling me about the business? So that's what you're getting a chance in this part of the unit now to focus on that issue. If you can get good at being able to do that, you're going to be 1 in 100. A great risk in accounting, and you feel this as we do our analyses, is you can end up just focusing on the numbers because they take up a lot of your space, focusing on this. And you can forget that we aren't interested in the numbers. We're interested in the business. And so if you can be able to, and you see, most people don't know how the accounting numbers are put together. If you know how the accounting numbers are put together and you understand accounting, you can then interpret those numbers and identify what's driving what and why. And that's such a helpful thing in a business of any size, so that management can then focus in on fixing or directing their attention on the key issues rather than on things that are secondary. We'll look at how this works with Ryman Healthcare. But Aeroflot's an interesting business, and you've got a bit of a sense, and you can see the importance of having a good sense of their strategy. What are they trying to do? And so Aeroflot, I think from what you're saying too, is looking to upgrade its fleet in certain ways, particularly to have fuel efficient and jets that are smaller that can go point to point and that sort of thing. A lot of airlines are seeking to do that. But it also needs to, it's got a poor safety record, so it needs to work on its reputation. And that obviously is a bit of a longer term thing. And also which markets it's particularly focusing on. And where it's seeking to operate. But it might have quite a domestic Russian focus as well. Does that help a little bit?
Yeah, that's good. Thanks, Martin.
And you can see the importance of discussing with each other. And just if you've made some good connections with some people, they're really important to get going and thinking about, because this is what will stimulate your thinking. And Maria, do you want to take us through some of the responses we've got then?
Yep, sure. Hannah and I are trying to work out your a bit ahead of time on slide 16. We'll discuss that when we get to it. Okay.
Yeah.
Got key accounting drivers of your firm being sales, RNOA, PM, ATO, sales and sales growth, and NOA. So that was they're the 5 little bubbles that Martin had on his slide. Profit margin, NOA and PM, return on net operating assets, PM. So we've got a lot of the same responses from the bubbles on Martin's slide about the key accounting drivers. And then we've got China Southern Air relies on sales growth by buying new assets, such as planes, improving and maintaining assets using capital injections from government grants. Oh, that's interesting. That's a bit similar. That first section is a bit similar to Hannah's company, Aeroflot. Relies on sales growth by buying new assets. I think in Aeroflot's case, though, they're leasing new assets more than buying them. But using capital injections from government grants, is that a long-term strategy, I wonder? That'd be interesting. Then we've got return on net operating assets, profit margin, earnings from people flying less, cost of operating planes. Sales, which is sales growth, growth in the sale of flight tickets without the use of discounts that limits the profit due to maintaining costs. Oh, that's good. That was something I thought about for Hannah's company too, discounting flight tickets, which is, like the sale price that Martin discussed. Whether that type of sales growth is impacting the future return on net operating assets or not. RNOA showed a dip in 2016, but has since increased significantly, 15.68% in 2017 and 28.81% in 2018, suggesting that they are getting a better return from ticket sales above the cost of planes as time has progressed. So perhaps a positive sales growth strategy. Similarly, there was a dip in sales growth in 2016 that then increased for 2017 but dipped in 2018, which may relate to the strike in that year that would have prevented certain flights from occurring. So again, connecting it to the business and economic reality. That's really good. I think that's a fairly insightful observation.
Yeah, you can see we're not just mimicking the slide of the numbers. They're starting to engage with it.
Yeah.
Now, some of the issues that were raised there were around profit margin. Reducing price to grow sales can be value adding. And if you go back to the video on good and bad sales growth, it explains why. And the issue there is we're looking at the economic profit framework for value add. And obviously, reducing profit margin will reduce our return on net operating assets, because return on net operating assets equals profit margin times asset turnover. So if the asset turnover stays the same, profit margins come down and return on net operating assets will go down. All other things being the same, that will reduce our economic profit. But if we reduce the return on net operating assets a little bit, as long as it's still above the weighted average cost of capital, and we grow the net operating assets a lot, then that can outweigh the negative effect of a dropping return on net operating assets if we're growing the net operating assets, and that could lead to growth in our economic profit. Ryman Healthcare, over a long period of time, has been growing its economic profit while reducing its return on net operating assets. Its return on net operating assets has been declining, and that's been largely because its profit margins have been coming down. But its net operating assets have been growing greater. The effect of the growth, huge growth in its net operating assets, has meant it's been able to maintain and grow its economic profit. So you're sort of starting to deal with some of those issues. So they're the sorts of comments. And so it's an interesting airline. It's controlled by the government, the Chinese government, but they've sold off a minority stake of the company to the private sector, and it's listed on the stock exchange. And so it has that sort of complexities in its ownership, and so they're sort of addressing some of the things that could be happening there. That's good. That's a good start. So you can see some people are a little bit further along and not. If you don't understand the strategy of your firm, if you don't understand what it actually does, this is where you've got to go back and do that. Connect much better into that. And otherwise, how are you going to forecast it with any sense? All right, that's quite interesting. That's a good start. Let's have a look at... so that gives you a bit of a sense of the sorts of things you're going to need to be doing. And so we're going to be needing to forecast the economic and business drivers of our firm in the future. And let's have a look at Ryman Healthcare. If we're going to be looking at, here we look at profit margins and net operating assets, return on net operating assets as well. And this is out of the study guide, but some of the economic and business drivers that I've identified for Ryman's, a key one is growth in residential property prices and values. And it's actually particularly sensitive to the growth in residential property prices in about a 10-kilometre radius around each of its retirement villages, and which are in New Zealand and also around in Melbourne, Victoria regional area, around Melbourne. And so they've behaved a bit differently in recent years, but obviously in Melbourne they've come down quite a bit. But there has been strong growth in the past, and the reason that drives one of the economic business drivers of Ryman's is because it can charge more for its retirement village units when it doesn't sell them, but it sells a lifelong lease, which is pretty similar. The amount it can get for that is related to the house prices in the area, because most people who go into a retirement village go into it from a 10-kilometre radius, and they sell their house, and that gives them the money to buy into the retirement village unit. So if those house prices are going up, they can charge more. And that drives value in a number of ways. One is the new ones they sell, they can get more for. The margins are enormous on these retirement village units. But also it sells the old ones. Because on average in the past, people have been spending on average 7 years in a retirement village unit. That's before they die or before they go into care of some sort. And the average age is now about 78 into retirement village units, and they go for 7 years on average, some more, some less. And so it gets to resell them. And so if the property values have gone up over the last 7 years, it can make a great margin on reselling them as well. So Ryman Healthcare is quite a play on house residential property values in New Zealand and around Melbourne. And so my view on that is that compared to the past, is reduced levels of expected future growth in residential property values. And I put in the study guide 0, 0 for 19 and 20, 5%, 5%, 21, 22, and 7.5%, 23. And in my actual work and modelling on that, it's a bit more detailed. But I just sort of put in that to give you a feeling for, you don't need to go into a huge amount of detail in these forecasts in the unit because we're just doing it over a few weeks. But that gives you a sense of my view. That's actually quite different to what's been happening in the past. And that's one of the key. So I forecast that. The other economic and business driver I'd identified for Ryman Healthcare was strong demand for retirement village units. This has been a strong driver of value for Ryman's for forever, for the last 35 years. And that's led to continued strong sales growth. Year in, year out for Ryman Healthcare. You could have a global financial crisis, it makes no difference. It just kept going. And it didn't stop. Ryman Healthcare is one of those businesses, at least in the past, that's been impervious to economic cycles. And given it's a property development company, that's extraordinary, isn't it? The reason for that is it's a need-based thing. People go into retirement villages when they need to go in. And that just keeps happening, regardless of the economic cycle. So strong demand, and I forecast continued strong sales growth. The reason for that is that there's about a 3% growth in people over 70, of the population over 75. There's population growth going on in New Zealand and Australia in that age group. But 3% isn't going to make you rich. The reason there's expected continued strong sales growth is continued growth in the proportion of people over 75, well, the average age is 78 to go in. The increasing proportion of that group that want to go into retirement village units compared to the past. It used to be quite unusual to go into this sort of thing 35 years ago, and it was sort of considered a bit like, a bad thing to do. You're going into some sort of care or some sort of integrated retirement village, you're sort of being a bit abandoned, But they've been developing these, they're like resorts, and the word, people really like them. And this integrated setup that Ryman's has gives people a lot of peace of mind, including the relatives of the people in there. They don't need to worry. If people get sick, they may not. But if they get sick, they can just gradually get more care where they are, and then they can go into different levels of care if they need it. And that takes a lot of stress out for the relatives as well as the people. There's also there's baby boomers coming through. There's a shortage of care facilities. So getting access to them is a very powerful. You may never need it, but knowing that you could get access to it is a powerful driver. So all these sorts of factors, I could go on about this sort of stuff, but keeping it simple. So I've formed a view about the different elements of its sales. Care fees, I consider, will continue to grow by 15% each year. There's various reasons for that. That's the sort of growth it's been having, and it's in a process of continuing to build new care facilities. So you can sort of see its growth, and it's maintaining that. There'll be some growth in the fees paid per person, but most of that growth is through increasing the size of their care facilities. Ryman Healthcare is the only organisation building new care facilities, that's like nursing homes and dementia units and all that, in New Zealand. The only ones. A lot of them are closing them down. A lot of them not-for-profits. So Ryman Healthcare is having quite an important role in New Zealand in creating some facilities for people, but it's the people in the retirement village units that will be able to get that seamless access to them. Also, if you do get sick and you're in a retirement village, you go into the care, but all your friends and your spouse or whatever, they're all there. They can come and visit you. You can go easily integrate. So care fees increase by 15%. Sales of new occupation rights, I've got 700 units each year. That's probably going to be a little bit conservative. They're growing their capacity to build these new retirement village units. Resales of occupation rights, the key thing is total sales of occupation rights 7 years previously. So you just go back to see what they sold 7 years ago, and if on average people are in there 7 years, that's what you can expect each year. And the management fees increase by 15% each year. So there's some of my key views on the why of the strong sales growth that's forecast. Of course, you've got to bear in mind whether it's value adding or not, the strong sales growth. And of course, Ryman Healthcare, its return on net operating assets is going down over time, but its net operating assets is growing more strong. The effect of the growth in the net operating assets is greater than the decline in return on net operating assets. So it's maintaining and growing its economic profit. So I'm sort of cutting it short a little bit, but there's stuff in the study guide as well, and some of the videos. So in forecasting return on net operating assets for Ryman Healthcare, I've forecasted the profit margin and asset turnover. I've kept the asset turnover the same, 0.25. Most businesses, you'll see as you look back, the asset turnovers are fairly consistent. The asset turnover will change if you restructure the business in some significant way, or if there's a major economic downturn, your sales collapse, but your net operating asset stays the same, for example. But typically, I'm expecting it will be around about that. It may decline slightly, actually, is my view, but it's probably not much. And then the profit margins, you can see I have coming down at 55, 50, 50, 50, and then I have them kicking up a little bit as well at the end. And this is related to the view on future house prices and a couple of other factors. But you can see I'm considering that their profit margin is going to hold up pretty well. That may be a little bit optimistic, but that's what I put in there. So that's what you'll be needing to do with your firm. And the quality of those analyses drives the quality of your valuations. So, and it's the focus, you see, of connecting those economic and business realities of the firm. Like, I've got a view of flat house prices. How does that connect to the future accounting drivers, profit margin, and so forth, return on net operating assets? And you have a look at the video forecasting net operating assets, and you can see some of these issues that I discussed there. Net operating assets is one of the accounting drivers that you'll be looking at. So with net operating assets, I'm at the... we've looked at factors of growth in residential property values, which I expect to be flat in this sort of 5-year time horizon. The strong demand for retirement village units, which I expect to continue, and there are various reasons for that. You can see a lot of these are quite predictable for Ryman's because, there's demographic factors and other factors. And businesses that I like and that a lot of people like, but I like, are ones that have growing, strong cash flows, economic profit that are predictable. And this is a classic sort of business that has those. Ryman Healthcare's capacity to develop, own and manage retirement village units, it's growing so strongly, but it has a capacity to do this. It's demonstrated a capacity to develop, own and manage retirement villages over a long period of time, and it's growing that capacity. And it's been able to develop the capacity in Victoria as well as New Zealand. Now, the rate of turnover of existing retirement village units of 7 years. Now, there has been some signs over the last few years that that's extending, that people on average are spending a bit longer in there. And so that is likely to increase, in my view. I think it has been happening in the past. They don't say anything about that. But if you look through their figures, you can see that the growth in resales of retirement village units hasn't been as strong in recent years as you'd expect. So, which suggests if you go back 7 years, it suggests that people on average are increasing their time in there. And so that may well increase to 7 to 8 to 9 to 10 over periods. And that will have a dampening effect on the growth in return on the return on net operating assets. In fact, it'll have a dampening effect of it and cause it to decline a bit more. And so that's something that I keep an eye on. And so I'm probably a little bit, if that's assumption, is probably a little bit optimistic. And the occupancy levels I expect to continue strong. Basically, they sell them off the plan. They're basically close to 100% all the time. High 90%, 94%, 90%. And so I expect that to continue, and that's because of the strong demand. And here I've put in my comments. I continue that Ryman Healthcare will maintain its significant capacity to develop, own and manage retirement village units. It will maintain its existing rate of turnover of occupation rights of 7 years. I've commented that I'm thinking that's possibly a little bit optimistic, and continued high occupancy levels. And you can see how I keep an eye on this company quite regularly, every quarter probably, because it's turned into quite a big investment, so I just keep an eye on it. And so I keep revising my view on these things. But I've kept it a bit simple here. So that brings to the forecast of return on net operating assets. Profit margin, asset turnover. Return on net operating assets is the profit margin times the asset turnover. So I've got 55%, 50%, 50%, 50%, 55%, and 0.25 I've got constant. That equates to 13.8, 12.5, 12.5, 12.5, 13.8% return on net operating assets. Given one of my assumptions of the 7-year turnover is possibly a little bit optimistic, those return on net operating assets may turn out to be a bit optimistic. I think the decline could be a bit more than that. But once the turnover rate stabilises again, say it might stabilise at 10 years or 9 years, then the return on net operating assets will recover a little bit. But that could be quite a few years out beyond the horizon. And you can see the forecast of net operating assets. I've got sales forecasts and asset turnover, and that will lead to the net operating assets, which is sales divided by asset turnover. And you can see how I've generated a forecast of net operating assets, which are growing strongly. And from all of that, I can calculate economic profit, which is return on net operating assets minus the cost of capital, all times net operating assets. And you can see these are big numbers. When you think that Ryman Healthcare has only raised $33 million from shareholders, $25 million in its float, it's got substantial economic profit being forecast. Again, that's possibly a little bit optimistic, given one or two of my assumptions, but that's what I've put in there. And regardless, they're solid numbers year in, year out. I mean, if it can make $1 billion economic profit, that's extraordinary. All right, so the identifying the economic and business drivers, and you can see the thinking with South China Airway that starting to think through, and numbers of people are starting to think through the business. It requires experience and ability to make sound commercial judgments. That's what we're doing, make sound. And so often people say to me, Martin, I'm just a student, or it might be an MBA, I'm not experienced in these different things. And so I'm still learning. Well, so am I. I'm always learning. We're just always learning. But I'm amazed how people can do this sort of thing and make some quality judgments. And it's really whether they're convincing or not. So I might make some judgments, and I very briefly discussed Ryman Healthcare, but it's slightly more thoroughly discussed in the study guide. But is that convincing or not? When you read it, you think, well, I don't think it's convincing. I think house prices are going to collapse in a heap over the next 5 years. And Martin's just got a constant or whatever it is. And you mightn't find it convincing for some reasons, or you might find it convincing. So some people can make more convincing judgments than others. But the key message is that now we're shifting our focus from the financial statements to the economic and business realities of our firm. We're going to engage directly with those. And so this some people will do it better than others. And this is really what accounting is all about in all its different contexts. And we're seeking to connect the accounting drivers of our firm, which we looked at: return on net operating assets, profit margin, asset turnover, net operating assets, sales growth, and sales. Seeking to connect the accounting drivers of our firm with its economic and business drivers. That's your challenge at the moment. So we've got a model. We can focus in on these key accounting drivers and then make the judgments. It's a subjective, judgmental leap into this. And in particular, the focus is going to be on expected future growth and the amount of net operating assets expected to support this sales growth. All right, we're going to go to we'll skip over this. We're going to go to we'll be coming back to this whole topic next week. Let's do the minute paper. What was the most important thing you learned today, and what questions still remain unanswered? You might just have a few. I'll give you 1 minute to answer that. What's the most important thing you did today, and what questions still remain unanswered? Okay, a minute is up. You can keep answering. There's probably quite a few things to say. Maria, do you want to start taking us through what was the most important thing you learned today?
Sure. I'm on Zoom at the moment, so I'll just quickly hop off. All right. That I need to look into what are the business drivers of my firm more. I think we need to do that too. We're going to sit down and really analyse those more solidly today in our tutorial. The importance of the analysis of ratios to determine what is the accounting driver of our firm. So that actually helped me, that structure, to, I guess, talk through the key concepts and issues with Hannah, with her company here. That identifying what the changes are in the value drivers alone is insufficient. I need to understand the actual actions of the firm's operations that correspond to those changes. That's a good takeout from today. Really connecting the accounting drivers, using what's happened in the past to help us predict the future and really connect to the business and economic realities so that we can more accurately, as much as possible, predict those future figures. Further understanding of accounting drivers, so again, the accounting drivers. I didn't know before today that sales growth could be good or bad, and how to tell using the change in NOA equals sales times the inverse of the asset turnover. That's an excellent point. I really liked Martin's video too. I learnt some tips from that. There is good and bad sales growth. So again, another key concept. I think most of us probably took a lot from that video, including me. Buying more assets, reducing profit margins may increase sales, but have a negative impact on economic growth. This can have the opposite effect of value creating and be value destroying. So a very good insight, and it takes me back personally to my teaching economic days when we used to look at the bell curve of increasing revenue through manipulating P, price, and Q, quantity. So I think that's interrelated as well. Growth in sales is not always a good thing. It can destroy value for equity investors. Yes, great takeout. And the economic and business drivers and profit margins. So there's some good key concepts that have been considered and hopefully started into our learning journeys today.
No, that's excellent. And so it's probably three key comments from people, key things learned. To know what to focus on, those accounting drivers, we've got a conceptual framework that can really help us focus on the key drivers of value in our firm, and then connect strongly to the economic and business drivers, which is really what it's all about now for us in the next few weeks. And also the idea that sales growth is not always good is excellent. And if you go into marketing, for example, pick at senior levels, it's so unusual, but we look for people who focus on value add, not just increasing sales. And because you can see how important it is, there's more to it. That's great. So let's go now to what questions still remain unanswered. Marie, do you want to take us through those?
Yeah, sure. None. When forecasting, how much can we assume what will happen? So I guess the question is, based on how well we understand the past, you can only assume as much as you have analysed your business in the past, I guess.
I'll comment on that.
Yeah, that'd be great.
Yeah. That's a good question. Look, we've got 6 more weeks of the unit, and so there's a limit to what we can look at, So when forecasting, there's a huge amount of information about our firms. But if we focus, the accounting drivers, looking through the accounting drivers helps us focus on key aspects of the business, but there's still heaps. So you do make lots of assumptions, and that's all good. And you can comment on the fact you thought about certain things, but it may be that it's difficult to get information on certain things, and also you're not expected to research in depth everything. So you definitely can make assumptions or just comment on, and if you take Ryman Healthcare, you could say you could research house prices in all these different areas in detail. There's all sorts of information available. But number one is how important is that? It is a fairly important aspect of value, but, really. And so you might just take some broad views about it. And And you can see I'm using numbers that cover New Zealand and Melbourne, both completely different property markets. So, there's all sorts of assumptions around all of that. And so, you could talk about that. Don't kill yourself. You don't have to analyse everything to death so that you're a pretzel. And also, that's not really what this is all about. People who are good at identifying value in businesses, either as an investor or as a manager, aren't people who just load themselves up with huge amount of data, but they're people who just focus on the key things. And it's pretty rare, actually, that skill. People tend to get distracted by things that aren't critical. Does that help a little bit?
Yeah, that's great. So the next question is, I'm still wondering how I will identify which actions the firm is undertaking in relation to the environment that they operate in that are affecting the value drivers of my firm. So how will I identify which actions the firm is undertaking? I'm literally doing this with Hannah now. We're using those formula that Martin has included, and we're actually we're breaking those formula bits down to guide us as to what to look at. So, for example, with the return on net operating assets, we're breaking that down so we're looking at the asset turnover and also the profit margins. So to get to the profit margins, again, we're breaking that down into looking at the operating income and the sales. So we're really breaking all of those formulae down, having a look and analysing, doing the figures for each of the inputs into the formula, and then writing about each of those inputs. And then as we're doing that, we're finding we're actually getting a better understanding of what is driving it, because we're having to discuss, what's happening with the individual inputs in the formula, such as the operating income. What's happened to the operating income? It's decreasing. But there's a number of external factors too, like Martin pointed out with the crashes. So we're also making sure that we consider that environment that they operate in, that you've put in there, which includes the risk of, safety risks such as crashes. They're also impacted by external prices such as the price of fuel significantly. So we're making sure we discuss that in relation to the environment that they operate in, because that also affects the operating income, which is one of the drivers of the firm, one of the key accounting drivers of the firm. So we're trying to connect, as we're using the formulae, we're trying to, for the accounting drivers, we're trying to connect that to the physical, like the realities of the firm, and we're finding that's helping us. So I don't know, Martin, did you want to comment further on that? They're wondering how they'll identify which actions of the firm are affecting the value drivers of their firm.
Yeah, this is a really good question. This is a question a lot of people will be having. How do I do this? And the answer is there's no list. Like, we've given you a list of the accounting drivers and so forth, but there's no list of actions. So how do you do this? Well, if you understand what your firm is doing and their strategy, these are sort of leaps of judgment. And it's like, why do I think that house prices are so important for Ryman Healthcare? It doesn't sort of look obvious when you first think about it. I can tell you a lot of other stuff that I don't put everything in these things. But say, how do you get that? Well, it's just through understanding the process of what they're doing, that people are selling their houses in the area. And then also, as you look at the company over time, you see, man, they're increasing their prices when there's a boom going on in the housing market, because they can, Also, other factors are like, when there's the downturn, like there was the global economic, the GFC back in 2008, 2009. So looking at what was happening there, well, they were able to buy more land cheaply. Prices of land were cheaper and they were able to access it. So they built up their land bank during that period, for example. That's helped their margins in the future because the land was cheaper. And they were able to get, so they did that. They also were able to negotiate better deals with the buildings, with all the building suppliers, building deals. They were able to actually grow their margins in that process, you see. So it's using whatever experience or judgment you got And a lot of it comes through talking with other people. I've invested in a lot of businesses in private equity, but also as an advisor in mergers and acquisitions, billions of dollars of businesses and valuing. And we never made any investment decision. I never made an investment decision on my own. If I did that, it would not have worked well. I might have had an idea to invest in something and I discuss it, but you discuss it with the group that you're working with. And people say, Martin, have you thought about this? And then I go, no, I haven't thought about it. And you're sort of like that, isn't it? So it's the discussing with other people. If you try to do it on your own, it's a hopeless exercise, making judgments in general. That's why in professional environments, people always make judgments in groups. Now, somebody might have to make the final decision, but it's with a lot of input. So I've been saved from a lot of disastrous investments that I might have thought was a good idea by working with other people. And so that's that process. So it is a good question. That is a question a lot of people will have. The answer is there's no list. You see, people often want to know the 5 things I can do to do something. Well, expertise isn't like that. Expertise is never like that. You think about driving a car. What are the 5 things to drive a car? Well, you could try to do it, but it's not going to be that helpful, is it? You've got to go and drive the car. And there's a whole heap of stuff. There's a lot of shades of grey. There's a lot of things. And that's just in a very simple area. Most people can drive a car and drive it reasonably well. But things like this, most people can't do. Most people can't analyse firms and value them very well. That's why there's a great opportunity to make money if you can get better than average. And you only need to be better than average in this game to make money. And so, it's shades of grey, there are judgments, and discuss with other people, engage with what your firm is doing, understand it, like what's Aeroflot doing? And you can see they've looked at the fact that the fuel prices have had a big impact on their profit line over the years. They've no doubt talked about it, and they keep fluctuating. So what's going to happen to fuel prices? You're going to have to forecast that for Aeroflot. And it's other strategies of buying new aeroplanes. Well, what's all that mean for their margins? It sounds like it's strengthening their margins. But is that really going to strengthen their margins? Because all the airlines are doing it. Is that going to have a downward impact on prices? And so, it's a whole heap of stuff. And in the markets Aeroflot are in, does that mean that there's going to be growth in people who want to fly around or not? And why? So it's a whole lot of questions. You can go on forever and drive yourself nuts. That's not the purpose. But you can see there's lots of things to discuss, and you just do what you can within, and this is true in how we analyse firms in reality, is you do the amount of work you can do within the allotted time you've got. And the trick, the people who are good at this are good at focusing their efforts on the key things and not on the secondary things. Because you've only got so much time, you can't be, you've got a life to live, you've got a whole heap of other things to do, you can only do a certain amount. And when you get good at this, you get good at focusing on the key things. So you'll be getting some experience of learning how to do that a little bit. Does that help at all?
Yeah, that's very good. Thank you. Just looking through the other questions remaining unanswered, I think they're pretty much, so it's how to forecast things such as sales growth through calculating